Welcome to the 2026 digital asset market. Capital moves in milliseconds, and algorithms process thousands of trades before you can even refresh your portfolio app. Then a sudden stop. Modern investors face a brutal equation, targeting 5 to 10x returns while attempting to shield their net worth from a catastrophic loss. This cluster graph represents thousands of crypto projects. Behind the hype of safe gains, 70% of alternative cryptocurrencies plummet to absolute zero. Surviving projects divide into two categories: a heavily capitalized baseline at the bottom and a scattered, erratic layer at the top. This split reveals the unbreakable law of the 2026 market. High returns mandate high risk. Capital preservation and exponential growth occupy opposite ends of the asset spectrum. Surviving this market requires mapping specific, calculated risk tolerances to a structured architectural framework. The foundation of this architecture relies on deep institutional backing and massive liquidity pools. On this risk versus reward quadrant, Bitcoin sits in the bottom left. Trading between $70,000 and $90,000, its current growth is fueled by institutional ETF inflows, regulated exchange-traded funds that allow traditional finance to enter the market. Ethereum, at roughly $2,200, and Binance Coin at $660 occupy the same low-risk zone. They carry a 2-star risk rating and a 3 to 5x return potential. Ethereum secures this position as the primary backbone for DeFi, decentralized finance, and Web3 applications. Binance Coin relies on its exchange ecosystem and token burns, a process where the network permanently destroys a portion of its supply to increase scarcity. These networks offer a high probability of steady growth throughout the cycle. However, because these assets command market caps in the hundreds of billions, the sheer volume of new capital required to double their price is immense. A 10x return on these leaders is mathematically improbable in the short term. Tier 1 assets function as defensive mechanisms, designed for capital preservation over rapid wealth generation. Accessing 5 to 10x multipliers requires moving into the growth engine tier. Returning to the quadrant, Solana at $90 and XRP at $1.40 drop into the exact center. This is the 3-star risk zone. Avalanche and Chainlink expand this central cluster, trading in the $15 to $20 range. These projects are utility-driven, maintained by active developer communities that build actual applications on the network. Solana captures share through ultra-fast transaction speeds, while Avalanche uses subnet technology, customized blockchains that run parallel to the main network to handle specific tasks. XRP relies on improving regulatory clarity for cross-border payments, while Chainlink acts as an oracle network, a vital bridge that feeds real-world data like stock prices into blockchain smart contracts. Targeting these higher returns introduces punishing price swings, and achieving that 10x upside requires enduring much deeper drawdowns. When Bitcoin drops 10%, these growth assets frequently lose 20 to 30% of their value in a single afternoon. Tier 2 requires trading security for realistic exponential upside, making it the primary battleground for growth-optimized portfolios. The extreme edge of the market replaces fundamental utility with pure narrative speculation. At the absolute peak of the risk quadrant, AI-focused coins like Render offer potential returns of 10 to 30 times your capital. This zone also includes new Layer 1 blockchains like Sui and Aptos, alongside meme coins like Shiba Inu that trade for fractions of a penny. Growth here is fueled by short-term hype, such as the current boom in artificial intelligence, rather than established long-term infrastructure. High-risk assets are